There is a lot going on with the new tax proposals coming out from the federal government. Hi, this is Paul, and thanks for jumping on Wealth Protector TV. Really excited for this episode. I have top attorney Harry Barth, who's the founder and senior managing partner for the asset protection, estate planning, and business planning firm BarthCalderon. I sat down with Harry. He's going to break it all down for you and let you know exactly what you need to know and what's coming down the pike. So let's go take a listen. Hi everybody, thanks for joining us here on Wealth Protector TV. My name is Paul Hitchcock, and I'm really excited to have our guest, Harry Barth, who is the founder and senior managing partner of the law firm BarthCalderon, focused on asset protection, estate planning, business planning. Harry, welcome.
Good to be here, Paul. How are you today?
I'm doing great, and I know this is a very hot topic. We're jumping right into the federal government new tax proposals that are coming out. Seems like it's changing every day, and you're going to break it down for us and let us know what's going on. So with that, I want to have you take it away.
Well, it's great. Thank you so much, Paul. Well, to say the least, we have a lot to talk about this morning. So let's put a few things in perspective. That these are proposals, and the hope and the prayer is that the proposals as being made will not be enacted by the federal government and be imposed upon the American people. We always remember the old adage that the power to tax is the power to destroy. And what I'm beginning to look at as I look at, and we're going to take a bit of a deep dive in today, as I look at the proposals that are being made, you wonder why they're being made. And sometimes I think there's an agenda inside in the agenda. President Biden has said that, he wants to reward those that earn their income by being wage earners, and at a cost for those of us that may earn our income as a result of investments or inheritance. So wealth unto itself is coming under attack. Now, it used to be in America that we had relatively stable tax policy. And even though political changes occurred, tax policy remained stable. One of the reasons why people from all over the world came and invested money here in the good old US of A.
They could count on us.
They could count on us being stable, that tax policy would not be implemented based upon politics. I think that's changed significantly. And when we examine the tax policies that are being proposed, and then we'll talk about their chances of enactment, it looks not so much as tax policy as it looks as political policy, and surprisingly enough, not as much about raising revenue as it is about being punitive or punishing those people who have been successful and taken risks under our capitalist system of government. So I think we have a lot to talk about. So let's give an example of some of the things they want to talk about. We have income tax changes, and we have proposed, and we have estate and gift tax changes. Now let's take a look at, just before I get into the specifics, what are the chances of it being enacted? And when would these rules become applicable to the people of the United States of America, should they be enacted?
Because they're debating right now, Harry. It's in the...
Yeah, they are. Right now, the proposals have been submitted to the House, submitted to the Senate, and they kind of mimic what President Biden talked about on the campaign trail. So they're kind of unified. So we had to have a perfect storm. We had to have Joe Biden elected president, which we did. We had to have the House being controlled by Democrats, which we do. When I say Democrats, we don't need to use the names Nancy Pelosi, although we'll use it anyway. And then we needed to have the Senate to also be controlled by the Democrats. We needed that triumvirate to happen to even open the door to this particular type of what I consider to be draconian tax legislation. So it seems to me more likely than not that we will have significant changes to our tax legislation, the most significant perhaps in the last 70 years. And to what degree is still subject to debate. there are moderate Democratic senators that may or may not go along with some of these more radical proposals that seem to be pushing America to the left. So the other thing that's important to understand is that there is a process in the government called budget reconciliation. And using budget reconciliation, they only need a vote of 51 in the Senate to pass the legislation. And if it's 50-50, we have 50 Republican senators, 50 Democratic senators. The tie is broken by Kamala Harris, and we pretty much know which way she's going to vote.
Right.
Okay. So what's the changes? So let's start a little bit different than last time. Before we get to the estate, let's talk a little bit about the imposition or potential imposition of capital gains taxes, or changes in the capital gains taxes. And I want to talk about this because I specifically had a conversation with one of our clients yesterday on this subject matter. So the proposal on first level, because we have several levels of proposal, is to change the capital gains tax rate for any capital gains greater than $1 million to the ordinary income rate. So the elimination of capital gains on anything over $1 million. And to change the ordinary income rate max from 37.6 to, I think it's 39.5. Meaning that when we have capital gains over $1 million, so if I have a business that was sold for $10 million, an equity event or a large commercial building that was sold that had a large gain of, let's say, $9 million or a $10 million gain, the amount over $1 million, instead of being taxed at 20% as it is now federally, would be taxed at 39.5%.
Big shift.
That is absolutely unbelievable. So that would mean that of the $10 million gain, $4 million in round numbers would go to the federal government. And if you live in a state like California and New York, in addition, the state would take 13%. So that would move us to close to 53. And then there's a 3% or so tax on a passive investment income. If it's considered passive, could take us as high as 56%.
Jeez.
At a 56% tax rate, nobody's going to sell. Who would sell? So yesterday, my advice to a particular client was, well, if it starts effective January 1st, 2022, and the sale was supposed to happen thereafter, I wouldn't sell. Work on your business, make it grow, and wait for better times. So what that's going to do is we're going to put a cramp on the mergers and acquisitions business. It's going to put a cramp in the legal business. It's going to put a cramp in the financing business. I don't see how this brings more revenue to the government, because people are not going to sell with a confiscatory environment of close to 60% taxation on a gain.
Right.
And I also don't understand the policy behind it, because when you think about it, these are people that have worked hard, they have taken risks, they've borrowed money, they've done personal guarantees, they've risked lawsuits. As you know, we're in the asset protection business, we look at it every day. All of that for years and years, paid income taxes, state and federal, on all of their money. And now they finally have been successful. And because of regime change, we have a sale, and 60% of it, or at 40% of it, if you're not in a high tax state, off to the federal government. I don't quite understand it. People are not going to do that. So I think that it's going to not generate any additional revenue for the government. But I don't think that that was the total concern. The total concern is to be punitive against those people that turn around and have built wealth. Because we've heard that if you follow the commentaries in the news, and the commentaries from many of the politicians, is they feel that the income concentration or wealth concentration is too narrow, and they want to spread the wealth around, kind of like a little bit of a Robin Hood, tax the rich and give to the poor. Maybe doesn't work in a capitalist society and may work better in a socialist society. So one of the changes that we have, of course, is raising the capital gains tax rate to 39.6%, which is unbelievable, raising the highest income tax rate to 39.6 if you're above $400,000 of income, and the list goes on from there. Now, let's shift back for a second on a few other things on the potential for the capital gains. In the new proposals, when a parent makes a gift to a child, there is gain. Sometimes there's gain that's built in. In other words, they bought a piece of property for a couple of $100,000 and they gifted it to a child, let's say $4 million, assuming they were still allowed to do that. We have a gain built in. And it's very, very possible under the new law that what they're trying to do is tax that gain at the time of the transfer. So any transfer of any asset would take the built-in gains and bring it subject to that the highest capital gains tax rate that we could possibly think of, above $1 million.
During their life and
during their
after?
lifetime, right, and at death as well. So one of the other proposals is that, you know, if you have an estate that's $10 million or $12 million, that the tax basis is $2 million in those assets. When they die and those $10 million worth of assets pass to the children, that $8 million, we're going to talk about estate taxes on top of this, that $8 million gain would be subject to a 39.6% tax. And potentially states could join along with that and actually increase that to anywhere from 55 to 60%. That is absolutely, and that's without even having an equity event on the property. Now, at first, it came out that it would be upon the sale of the property, there would no longer be a step up in basis. Then another proposal was, well, no, just on the transfer of property, whether it's sold or not, the capital gains tax would be due. And of course, this is not the first time that this has been proposed for the elimination of the step up in basis. But one of the problems that we face is, how do you calculate it? If some of these things go back 20 years, 30 years, nobody knows what the basis is. It was so hard to calculate. We would have to spend tens of thousands of dollars trying to figure out what the basis is in order to implement this tax. So one of the reasons it was abandoned before and never got enacted is because of the difficulty in implementing it.
Well, yeah, it seems the responsibility of the fiduciary responsible for figuring out the tax basis is onerous beyond belief.
Yeah, and not only that, it's very difficult to do. So because it's difficult to do, in addition to the actual tax itself, you have the cost of compliance with the tax, which is like another tax because we have to spend all kinds of money with professionals to try to figure out how to determine the basis. So this whole thing, and I'll come back to it, is one of the central, call it central themes of the new proposed tax changes. Let me shift for a moment back to the other one, and then we'll talk about enactment, and that's the estate and gift tax changes, which are unbelievable. So right now, everyone in America has $11.5 million of an exemption from federal transfer taxes under current law. And that's indexed for inflation, move up with inflation as it goes along. And the tax rate is 40% for everything above 11.5. And right now, the estate tax and gift tax rates are unified. So we can give away 11.5 million during our lifetimes, or use the 11.5 million at death times, and with a 40, you know, per person, per individual, not to each one that we give to, but I have 11.5 million, my spouse has 11.5 million. Under the proposals that have been submitted to the United States Senate, they're proposing a reduction of that from 11.5 million to 3.5 million, and also changing the gift tax from 11.5 million down to 1 million during lifetime. So we can give away 1 million during lifetime and no more than 3.5 million at death time without the imposition of transfer taxes. And not only that, remember, the gift tax would also be subject to potential capital gain upon the transfer of the gift. So basically, we wouldn't see very many gifts, or the gift would be ridiculous. And the rates would go from 40% to increase of 45% transfer tax rate. And then depending upon the size of the estate, it scales in the proposal up to as high as 65% for $1 billion estate. But for the average, it's between 45 and 55%. This is actually after getting a credit for and paying a capital gains tax on any built-in gains that happens on the property being transferred. Again, the level of reaching that is almost confiscatory. Now, so we got an increase in rates and a decrease in exemption amounts. And at least in the legislation that was introduced, there was no index for inflation as well. So therefore, as the cost, as we have inflation, which we would inevitably have, that exemption amount is worth less and less and less. Insidious, but basically built into the system. And of course, we've all read that Mr. Biden wants to increase the budget of the Internal Revenue Service by $80 billion for enforcement, saying that that $80 billion investment will return $700 billion to the United States Treasury by exacting taxes that they believe are not being paid now. So the Internal Revenue Service becomes a kind of a high tactical financial police with unbelievable power, and the intrusion into our personal lives by the Internal Revenue Service and the disdain for our country may rise. And I believe we're going to see if these things are enacted, a significant rise in expatriation from the United States of America. This is not taxation. This is confiscation.
You mean expatriation, people moving away
people
or
leaving.
moving their assets?
Leaving. No, people leaving the United States of America. Moving assets really doesn't matter because as a citizen of the United States, we are subject to capital gains taxes and estate taxes anywhere in the world. It doesn't matter whether we live in New Zealand or Australia. For U.S. citizens, we're subject to the same level of taxation. And one of the concerns that we had, or we thought we did not have, was the date of enactment. I want to talk about that. This is the main reason for this update as compared to last time. So when I spoke last time to our audience and our constituents, we talked about at least the way that the legislation was submitted, that we had some runway, that we had from now or a couple of weeks ago until the end of the year before any anticipated enactment of these draconian tax changes. So it gave us an opportunity, at least a limited opportunity, to work with everybody and take advantage of the laws the way they are today. We calculated, by the way, in a family that has $23 million of assets or greater, and there are two spouses, that the implementation of strategies that we have today that we can still implement are worth close to $19 million in transfer tax savings to the next generation by implementing them today. It's just absolutely huge. For example, another thing is intra-family discounts that we have now that we use with limited liability companies and limited partnerships are also targeted to be gone. So in the enactment, it was January 1st, 2022. Then what we heard, or some reporters are reporting, that although the rate and the exemption amount may not go into effect till January 1st, 2022, all the tools that we use to help you lock in what you have now under current law will be taken away as of the date of enactment of the legislation. So if they enact the legislation and President Biden signs it on July 1st, that our runway for the things that we would do to protect you from the January 1st, 2022 change may be taken away.
Wow. It's like irrevocable trusts and different strategies.
Well, we'll talk about grant to retained annuity trust, sale to intentionally defective grantor trust, using generation skipping transfer trusts would be eliminated on the date of enactment. And then to add insult to injury, we're now hearing some scuttlebutt that some of our dear legislators would like to make the capital gains tax and income tax increases retroactive to January 1st, 2021.
Wow.
So retroactively. I don't think that will gain muster at all. It's extremely radical, but again, the proposals are radical, so I think that we need to be aggressive. Other thing that we must remember is that under current law, depending upon the state by which the planning is done. Trusts can last in perpetuity or 300 years. Under the new law, no more than 50 years. So every 50 years, there would be a stop on a trust, be subject to transfer taxation, and then move on. So the trusts in perpetuity, or the dynastic trusts, would also disappear. So there are a few other things that that I wanted to bring to the attention. So we have, let me just go down the list for a second. I made a bit of a list to be helpful. So we're going to have decreases in gift and estate tax exemptions, and along with that, the generation skipping transfer tax exemptions. Increases, as I spoke about, in the estate tax rates. Elimination of a very important tool, grant or retained annuity trusts. Or severely limiting the use of grant or retained annuity trusts, which are very, very interesting tools that we could use to help pass assets from one generation to the next without using up much of our gift tax exemptions. Some of these were pioneered by the Walton family, and then when the Walmart stock went from generation to generation. Elimination of sales to an intentionally defective grantor trust, including intentionally defective grantor trusts and all grantor trusts, which are tools that we use where the income tax remains with the grantor, yet we've shifted the assets to the next generation for estate and gift tax purposes. So if we didn't shift the income tax, then that would also be included in the estate. So these are all very important tools that we have to deal with. Now, the income tax changes that I just wanted to run through very quickly is understanding that over $1 million, long-term capital gains will become 39.6%. I just discussed that earlier. That is unbelievable, because we have to remember that in California, for example, we have a 13%, potential 13% tax. And now the state legislature is trying to move that to 16%. And also in California, for those of our listeners that are in California, we have the intersection of that planning with Proposition 19, right, that God-forsaken piece of legislation that was misled through the election process in November. And there is some legislation pending to kind of hold up the implementation of Proposition 19 for a couple of years to allow people some time to seriously plan for their families. Because if we wanted to take advantage of making a gift while the gifting is good, so to speak, in 2021, we could cause a quintupling or a quadrupling of the property tax on the property. Mm-hmm. So that doesn't, so on one hand, we eliminate some of the potential capital gains tax by making gifting today, not actually, excuse me, the gift tax, but causing an immediate increase in property taxes. And then if the children elect to sell the property and not do it, then they were going to be subject to a capital gains tax on all of the gains. So
and that's on the books now. I mean, that's law.
Prop 19 is on the books now. There are some movement to delay its implementation to give everybody a chance to plan, because it just got passed in November, got implemented February 16th. So for other than people that had the availability to reach, advanced estate planning attorneys, which we were extremely busy towards the end of the year, they just didn't have the chance to plan for their families and got caught in this Prop 19 web. There also is going to be the proposed increase in the ordinary income tax to 39.6%, reduction in itemized deductions, reduction in the benefit of retirement contributions, reduction in the benefit of charitable gifts, increase in Social Security, taxation for those people earning over $400,000, and potentially even eliminating a 1031 exchange on real estate.
Yeah. So is that going to happen, the 1031 thing?
We don't know.
Yeah,
we don't know what's going to happen, what's not going to happen. Again, you have to say what's going on here. So what's going on here is, I don't think, a question of raising revenue with substantive and relevant tax policy. I think this is, let's speed up and punish those that have been successful in the United States, who've lived the capitalist dream, who started with nothing. I started with nothing. Many people started with nothing. We worked hard all our lives. And now the government wants to confiscate anywhere from 50 to 60%. That's the stealing of the American dream. So what am I suggesting? What's the whole purpose of this?
Yeah, what do you recommend?
I think it's really important that each and every one of our constituents, each and every one of our listeners, reach out to a firm such as ours that is totally prepared and educated in this particular area. Do a deep dive into due diligence. Let's look and examine the impact for everything that we currently have and see what the problems are and what they could potentially be. My plan is to plan for the worst and hope for the best. So my plan is, let's plan as if all of these things went into effect. What should we do? And hope for the best that it doesn't get enacted, and we've just engaged in really good planning. And there's a great intersection. You know, I've spent my entire legal career dealing with estate taxation, estate planning, and asset protection. Well, my God, if I've seen a term for asset protection, it's asset protection, but we think of it, we're always thinking about a tort creditor or someone who's
Right.
suing us for a
Right.
car crash or something went wrong in an apartment building that we own. Well, when you got 60% confiscation potentially by the government, that's asset protection as well.
Yeah.
And so I think we really need to do that. And that's what I really wanted to bring out today. Now, whether or not, and I doubt that all of these draconian proposals will be implemented by the government, I think there has to be some sanity in the government. But if there's not, even if worse comes to worse, we punt. We stay in a holding pattern. We help our clients stay in a holding pattern. We hold up sales. We do not have equity events. And then we wait for more sanity to return to U.S. tax policy, which I believe and optimistically believe will happen. I also optimistically believe that hopefully that not all of this will happen, and more stable, livable tax policy will take place. So right now, and that's why they called it the 95-5 Act. It only affects, in their mind, 4.5% of the people. But for our constituency, it's almost 100% of our clients.
Right.
So we are very, very, very serious about this. Now, the understanding also is that for people, we need to plan and plan early, Paul, because we're just going to run out of time, bandwidth in all firms similar to ourselves before the end of this year or before enactment to take advantage of some of the great rules that we have now before they disappear. And Paul, do you have any other questions? If not, that's basically what I wanted to say.
Yeah,
Today.
no, it seems, Harry, that the strategy to take away is that people need to get educated. Whatever you have going on, you've got to understand how you could be impacted and then put a game plan in place that's also flexible enough to deal with whatever ends up happening here, which is part of the assessments that we do at the law firm is to look at. Is that a good way to put it?
Yeah, absolutely. And another one I'd like to just say, and again, this is not pushing people into our office. This is not quote unquote the sales job. What we have here is that time, effort, and money spent in this planning, the return to a client, all right, or potential client, is significant. If we could save a family $19 million, $20 million plus at this time, that is probably the best investment that they can make for the next generation, rather than any other thing that they could do to try to increase the value of their business, is to protect the value of what they have for generations 2 and 3. We have a very short time frame in my mind. And Donald Trump, and I'm not meaning to be political, said that elections have consequences. And elections do have consequences. And I believe this is a consequence of the last election. So may it not happen, but if it does, may we all be prepared for it. And thank you.
Harry, fantastic as always. And I want to tell people before we go here is that wherever you're watching this, we are going to be multi-streaming this to many channels. You may be listening it to on a podcast. There will be an opportunity to get with us one-on-one for a complimentary strategy session with Harry and the team. So look for that around this. Harry, incredible information as always. Thank you, everybody, for listening. We'll see you next time. Thanks, Harry.
Thank you. Bye-bye.
All right.